Hey guys, welcome back. My name's Aaron. This is Czar Finance, episode 33. You're watching Fundamental Analysis Income Statement. Now, when it comes to an income statement of a company, and you just go to a Google search site and just type in the name of the company, income statement, you'll be prompted with the thing that basically shows revenue, revenue, expenses, and that equal profit. So what does that mean? So long story short, revenue is basically what the item is being sold for or selling, and how much revenue or how much stock of an item is being sold. Um, the expenses, how much does it cost to make that material that is being sold? And if you take the revenue minus the expenses, you're going to get profit. So say for example, say I have this water bottle here, okay, that costs $4 to make. Okay, it cost me $4 in plastic and all the different things that I need to get the filament and all those type of things to manufacture this bottle, and I'm going to sell it for $5. So my $5 is my retail value of this bottle here, and that's my revenue. That's what I'm charging the customer to sell. So how do I know how much profit I make? Well, I take the revenue of the value of this product, $5, minus what it cost me to make with the materials, which was $4, and I have a profit of $1. So that's my overall income statement for this small example here as a water bottle. My revenue, my expenses for what it costs to make, and the overall profit of what it is. So that's how you view an income statement. Now it just goes on a larger scale. Say, for example, you look at Nike. Nike's income statement, for example. They maybe made like, I don't know, you take like $37 million for sales of sneakers and other Nike products, minus what it costs them to manufacture those sales of Nike products, of the shoes and the things like that, and you minus that from the sales of that, and you get the profit of what they made for the company. Now, there's another thing to think about when it comes to expenses and things like that, is the operating cost. How much does it cost to operate the company? We're talking lights, administration, things like that, the cost of goods sold. So it's called cost of goods sold, or COGS, cost of goods sold, and selling general and administrative expenses, selling SG and A, if it's called. Those two things also come into a factor of what it might cost to manufacture something. So say for example, it takes me back to the water bottle example, it takes me 50 hours to manufacture this, to get the raw materials delivered to me and manufactured and made into the shape before I actually sell the product. Those are expenses that could be added into the operating expense of the product itself, to keep the lights on, what my salary was to make this thing, the electricity used to generate the materials to form this shape of the bottle, etc., before I actually go out and manufacture it and process it and sell it in stores and package it and stuff like that. So that's the operating expense, cost of goods sold. What does it really cost? But really, long story short, it comes down to a couple things. Revenue, what is the thing selling for, minus what it costs you to make it, gets you the profit, and there you go. That's what a company is based on, is how well it's doing. Now, looking at that again, if a company's growth profit is going up year after year after year, that's a great sign that the company is showing growth and is showing strong increases. Maybe they're taking their profits and they're putting it in R&D for research and development, or maybe they're using it for marketing purposes. Maybe they're taking the profits and reinvesting in themselves. Maybe they're taking some of that profit and they're going to pay back the dividends for people who invested in them as a thank you to them. That's the way dividends work. It's somebody, so you or me, we give them our money to help grow the company, to help them do some great products, so that in hopes they turn around and give us cooler, better water bottles or something like that. And as a thank you for the company, they turn around and give a kickback or a share, which is a dividend, back to the customer as a thank you for them being loyal and investing in them for a certain amount of time. So basically, that's what an income statement is. You're going to look at that. It's really, really straightforward. It's simple. Take a look at that and analyze it. Look at the companies for growth that show growth. There's a wide margin of growth. If they're not showing growth year after year after year, or if their competitors are doing a little bit different than what they're doing, and they're not kind of growing as a cluster, maybe there's something wrong there. Some things to kind of consider. Why isn't this company following? Why isn't Nike's sneaker company following the same things as Adidas and Puma and all these other companies? Is there something going on? Is maybe not a lot of people buying Nike or whatever? It could be any company, for example, but they should generally kind of cluster together because they're in the sneaker market, for example. in the shoe market. So I hope that helps explain what an income statement is for fundamental analysis. Next week's episode, we're going to get into talking about a balance sheet. And I really hope that you take a look at this, and hopefully you're learning something from this. Again, my name is Aaron. This is Czar Finance, episode 33, Fundamental Analysis, Income Statement. Take care. Bye-bye.